Welcome to Homegrown Wealth, where we discuss how to grow your wealth through home ownership. Today, we're going to tackle one of the biggest hurdles when it comes to home ownership, and that is your credit score and your debt to income ratio. I'm going to walk you through what's important, what you need to know, and how you can help if you have credit issues fix those items. So, the first thing we're going to talk about is understanding your credit score because I feel like a lot of people think they know, but not necessarily know. So your credit score is a three-digit number. It can be anywhere from 300 up to 850. And typically what most lenders use is called the FICO score. I know that there are other scoring systems out there, but they're not accurate and they're not used by any mortgage professional when it comes to giving you a loan. So FICO is the one that you really truly need to pay attention to when it comes to your credit score. The biggest factors when it comes to your FICO credit score. Payment history makes up 35% of your score. So that is the biggest chunk. The next is your credit utilization. That is 30%. Then we have length of history, which is 15, and credit mix at 10%, along with new credit at 10%. So this is how your score is made up. Let's talk about credit scores and why you should care. Credit scores are now pretty much used for everything as far as utilities being activated, being able to get cable or internet in your name, being able to qualify for a car, and most definitely a home loan. So they matter, and you should take care of your score. The higher your score, the better it is for you to qualify for just about anything that you can afford. So, I want to address something because I know a lot of people feel like, oh, I've heard the 580, I can get approved at 580. These are my feelings on a 580 and below. You need to work on what you have going on with your credit. You need to improve your scores because this is what I can tell you from experience with people at a 580. It's a lot more paperwork. And I'm not talking about 10 more papers. I'm talking about you have to turn in so much information to the lender to prove that you have the income and that you will pay this mortgage on time. Also, you cannot get gift funds from any family member or any significant other to help you purchase. When you have a lower credit score below a 620, technically sometimes below a 600, they will not let you use gift funds. So that means everything will already have to have been seasoned in your bank account. Seasoned in your bank account means it needs to be in there within the last 30 days and sitting untouched. Next, with the 580. Let's look at it this way. You need a big down payment. You need to have money put down. So when I say that, let's talk about 20% of whatever the total purchase amount is on that home. It's not an extra 10, it's not an extra 5. No, you need to have about 20%. So let's say that you were getting a house for about $100,000. You need to be able to put $20,000 down on that house, whereas someone with good credit could put down as low as 3.5 or 5%. If they wanted to put up to 20, they had that option. But it would probably be mandatory to put that down. So this is what I will say for anybody at 580 and below. If you're really at 600 and below, please heed the lender's warning when they tell you that even if they can move forward, it's probably going to be very hard, and you should really just work on improving your score at a 600 to a 640, because 640 is usually that starting point when it comes to your credit score. It's something as simple as you probably need to pay off a bill, pay down a credit card, or even open up a new credit card to help you get you where you need to be when it comes to getting a home loan. So let's talk about what you can do to bring your score up if you're not at a 640 or higher. So once a year, you're able to go to annualcreditreport.com and you're able to pull your credit report and see what all is on there. It's going to have your accounts in good standing, your payment history, any derogatory items that are on there, or any collection accounts showing. Now, you also can pay an extra fee and they will give you access to your credit score. So that way you would be able to see all 3 credit scores for an extra fee. Now, if you're like me, you like apps on your phone, then you can use what's called MyFICO. MyFICO to me has been one of the most accurate apps when it comes to your credit score and credit monitoring. When you sign up for MyFICO, they give you access to one score to where you can monitor and see what your score is doing, what all is on your account. What I like about the MyFICO app is that it also shows you the mortgage lender, which FICO systems they're using, and what your scores look like in each FICO system. It does this for insurance. It does this for several other things that would actually qualify you when you have to run your credit to get anything in your name. So it does break that down pretty well. And to get access to the other two scores, it's a small fee as well. So start there and find out what's on your credit. Um, Going from there, so let's talk. 35% of your total score is paying bills on time. I'm just going to be honest with you. If you're at a point right now to where you're a month behind or 2 months behind, 3 months behind in bills, you don't need to try to seek home ownership. You need to be stable. You need to be paying your bills on time every month because the lender's going to want to see that. Now, sidebar to what I just said. If you have two 30-day late payments within a calendar year, you automatically will not get qualified for a mortgage. That's just how that works. They don't like to see late payments. One payment, it may be excusable depending on the account and how much. Two late payments, you're going to have to wait until that second 30-day late falls off or is a year old before you can then qualify to even apply for a mortgage. And that's just being very honest. So I want that to stick to you about paying your bills on time. Now, with that being said, utilization, credit utilization, this is pretty much like your credit cards. And I know people say, oh, credit cards are evil. I can't stand credit cards, da 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 da. You were never taught how to properly use your credit card. And there's nothing wrong with that because I'm going to tell you how to properly use your credit card. So let's say that you have a credit card and you get a limit of $10,000. You have to keep the utilization of that card at 30% or less. So that means $3,000 is your cap on that card to be able to use it to where it doesn't adversely affect your credit in a negative way. So, if you reach $3,000 on that card, stop using that card, pay that card down, pay it off. They really like to see that you can pay your credit card off every month in full. If that's not the case, they do like to see that you're making up the payments, that you're keeping up with them on time, and not just paying the minimal, but you are actually trying to chunk down at your balance. That is always key and it always helps. The length of credit history. So, one thing I've learned is that you never want to shut down a credit card. Personal experience, I had a card for years, for probably about 10 years. And the last 3 or 4 years, I tried to do credit increases and they would never increase my limit. And so I just got mad. I took the one little auto bill I had on it off and I just quit using it. I think after 2 to 3 years of no usage, they finally shut it down for me. Now, the fact that they shut it down for me, it did not affect my credit. But had I called in to say, hey, shut down this card, I no longer want it, close it, that could have dropped my credit score. And let me say this too. One late payment on your credit score could take you down anywhere from 80 to 100 points, if not more. So that's why it's important to pay your bills on time because sometimes you don't even have enough to lose 100 points. So let's talk about if you have a limited credit history, which means maybe you have no score, you have a low score. Let's say you tried to apply for a credit card, you didn't get approved for a credit card with a limit that you didn't have to pay for. So here's some options for you. You can get what's called a secured credit card. A secured credit card is where you say, hey, I'll give you $500 to $1,000 of my own personal money to start up a credit line that reports to my credit report every month. I'm going to pay on this. Usually within a year with good payment, good standing on that credit card, whoever issued the card will sometimes give you back your deposit and give you a credit limit. Now, if you don't do well, I guess you'll have to wait for another year or so. I'm not for sure how that works, but that is one way to get started with a secure card. Now, this is what clients have told me in the past. If you have a credit union that you bank with, do not take a loan out when they say, oh, we can get you a loan. We can help you build your credit. The number one way to build your credit faster is to get a credit card. Opening a new credit card can sometimes just give you those boost of points that you need. I've seen it give 30 points, some people 50 points, some people almost up to 100 points. It really just depends on where you are. So if they're not offering you a credit card or a secure credit card, do not take that loan. And the reason why I say this too is because one, if you take out another loan, that goes against your debt to income ratio. Don't do that. Second, you're paying back more money than what they loaned you. And loans take much longer to actually show improvement of your credit score versus the 6 months or 12 months that they're going to give you to pay that loan back. So just forget the loans. Either get a credit card or a secure card. That's something that some of my preferred lenders will tell people all the time when they're right there on that line and they don't have a credit card. Open a credit card, and then bam, it shoots them up. They get a pre-approval. So let's say that you're looking over your credit report and there are some derogatory accounts that are on there, some collection accounts. So this is what I would tell you. You want to call that creditor and you want to have a conversation with them. Sometimes they have what's called a pay to delete letter. So the pay to delete letter is where you can say, hey, if I pay this balance, will you delete this off my credit report within 30 days? Usually they'll either send you an email stating this or they'll mail a letter to your house saying like, hey, if you pay this, we will get this off of your credit report. So that is called a pay to delete letter. If they're not offering you a pay to delete letter, refer back to what your lender told you as far as getting that removed, or just get with a credit counselor or someone that is a credit professional on what you should do next. But most do offer a pay to delete letter. And just to let you know this too, sometimes you can settle for less than what is owed and still get a pay to delete letter. So don't always feel because the collection is there, you have to pay that full amount. Sometimes you can pay as low as maybe 80% of the balance of what's owed, sometimes a little bit less than that. So there are some ways to get that down. But the key word is a pay to delete letter. If they're not offering you that, just refer back to someone else and then call them back and know how you want to move forward. One thing I want to say about the collections, yeah, we are adults now, and you have to be an adult, and you have to get on the phone and you have to talk to people. It may be an uncomfortable conversation, but it's a conversation that needs to be had because the conversation you're scared to have is limiting your growth as a person. So, this is what I want you to know. If you see collection accounts or anything like that, get on the phone and call and see what can be worked out. If you know that the payment is coming up due or you're about to run into a 30-day late, please call the company and see what options you have to work on that so that you can avoid a 30-day late payment. We have to be adults. Please get on the phone and start having these conversations. If you don't like to get on the phone, I don't know if it's possible to email and get a quicker response. Sometimes it is. It depends on the company. But let's be adults and let's get on the phone and let's start having these necessary conversations. What they say, a closed mouth does not get fed. What score is going to get you started with the home buying process? Typically a 640. A 640 is a very safe score to get qualified, to get pre-approved, so you can start your home shopping experience. And even if you're looking to sell your home, you still need to be at a 640 or higher because technically you go right back into being a buyer and the same rules apply to you. So, with that being said, you want to be a 640 or higher. Anywhere from like a 640 to like a 740, the rates may vary just a little bit, but that is typically a decent credit score. A 740 up until about maybe a 800 is good. Anything 800 plus is exceptional. So if you know you fall into those lines, you're doing everything great. Keep the course. Nothing needs to change about what you're doing. So let's talk debt to income. So debt to income ratio is your debts minus the income that you bring in every month. So it's ideal not to have large amounts of debt when trying to get a home. So let's write that down a little bit more. What the creditor or what the lender is going to look at is everything listed on your credit report that you pay out monthly. Now, outside of your credit report, what also is included is any payments to the IRS, child support, and alimony. Those are the other three things that would factor into your debt to income ratio. So they're going to look at your credit report. They're going to see car payments, credit card payments, anything that you're paying on. If you have a signature loan, a personal loan, or anything like that, home equity line of credit, they're going to see that and they're going to say, okay, these are your monthly debts. This is your monthly income. This is where your debt to income ratio lies. If you are over 50%, if you're at 50 or over 50%, it's going to be very hard for you to qualify because your debt to income ratios are extremely tight. Now, the most ideal place to be is at least 36% or below. But That's not always ideal in today's times. That's not always the case. So typically, if you're at 43% or below, you can usually qualify for conventional. Anything above 43%, sometimes it would have to be FHA. If you're looking to go USDA, they also are very strict on what their debt to income ratios are as well too. How can you improve your debt to income ratio if you're told that it's high? So I'm going to be honest with you. It's literally only two ways. You're going to make more money, which means you're either going to get a raise on your job, you're going to get another position with higher pay, you're going to pick up a second job, you're going to do something to help you with that. Or you're going to pay down debt, which means you're going to have to get on a budget and you're going to have to try to figure out which debts you can pay off first to help reduce your DTI. This does need to be said. Debt to income ratio is just as important as great credit or good credit. I have seen someone in the past, and this was just one rare time occurrence. Credit score was great, income was great, DTI was 60 plus, and unfortunately, she just didn't qualify. So please know that if your debt to income ratio is too high, one, it will limit your purchasing power that you have to purchase a home, or it could hinder you altogether from qualifying until you're able to get your DTI down to 50% or less. Now it's time for questions about credit and debt to income ratio. So let's see what you sent in to me. So the first question. I've heard that checking my credit score and increase can actually lower it. Is this true? How often should I check my score? So checking your score doesn't hurt it. What would hurt your credit is if you were doing, say, like a lot of credit checks, but checking all that on an app or online is not going to hurt your credit score. But let's say if you're at the store, and we all know how these stores are now, every store literally has a store card, and they're like, let me run your credit, let me run your credit, let me run your credit. That's going to hurt. It's not going to hurt as bad, but it hurts. Stop letting everyone run your credit. I'm not really big on store cards. Get your card that works everywhere, that you can earn rewards on, that you can earn points on, you can earn travel points on. I think that's more important than a store card. And question number two, my debt to income ratio is too high right now to qualify for a home. Should I focus on paying down debt or trying to increase my income? That's a good question. So, which one is easier? Are you in a field to where you do have the option to have higher paying income? Are there positions open that you could go apply for and you can receive higher paying income? Or right now, is it better for you to get a second job, something that can be reported, something that is W 2, that you can use as a means for secondary income to help you with purchasing a home? That's just really more of an individual case by case scenario. For some people, yes, they can go get a higher paying job. And for others, no, you probably do need to take on a second income to help you with purchasing power. I do want to point out two things. Credit Karma is not reliable. It works off the Vantage score system. Whatever they tell you your credit score is, that's not your credit score. Now, what's reporting on your credit is probably accurate, but the score is completely wrong. So don't use Credit Karma when it comes down to trying to base your credit score on where it is currently. Number two, remember in episode two when we talked about 1099. So a 1099 employee has to have employment for at least 2 years with a 1099 to even qualify for a mortgage. So in the process of trying to pay off your debt, just remember, you can't take on a 1099 position if you're trying to do something quicker than 2 years. Now, if you have time to wait, by all means, go forward. But if you're trying to do something in 2 years or less, you really need to be focused on the W 2 secondary income. All right, so let's talk about the history of credit scores. Credit scoring, as we know it, is fairly new today, but the concept of credit worthiness has existed for centuries. Now, who do we have to thank for the credit scoring system? That would be Bill Fair and Earl Isaac. They found the Fair Isaac Corporation, which is FICO, back in 1956. I want you all to master credit and debt to income ratio to help you unlock the home ownership goal that you're looking to pursue. So let's recap highlights from today's episode. Number one, Check your credit reports at least once a year and dispute any errors you find. 2. Focus on big factors, on time payments, and keeping your credit utilization at 30% or less. 3. To target your debt to income ratio quicker, tackling the debts with the highest monthly payment is actually best. 4. Build a relationship with the mortgage lender early in your home buying process. So that way, if you need a little bit of extra care, they can help you along the way. 5. Avoid major financial changes in a month before applying for a home loan. And 6. Remember that improving credit in DTI creates overall financial health beyond just qualifying for a house. Thank you for tuning in to Homegrown Wealth. Follow me for more tips and to get answers to your home ownership questions. Subscribe to my YouTube, share with anyone in your circle or anyone you know who may be interested on how to build wealth through home ownership. Next episode, we'll be discussing inherited properties.